Okay, hi there, guys. Sorry I was a bit late on today. Just let me know if you can hear me loud and clear, if it's all coming through clearly, and then we'll get stuck into it. Really just late because I had to make myself a coffee. Can't live without it these days. All right, hope you all had a good weekend too. All right, g'day, Paul. How are you, mate? All right, looks like we're doing okay. You can hear me clear. Let's get started then. Welcome to Trade Setup, guys. Welcome to the live stream. What's the date today? The 14th of May. So kicking along nicely in May there. Well, anyone that's new or watches this later on, welcome. Just remember you can join us on Twitter, which is the top left-hand corner. That's our trade_setup at Twitter. That's our Twitter, what do you call it? Twitter handle, I think it's called. I'm relatively new to it. I can post stuff, but I don't know the lingo yet. The top right-hand corner is Facebook. You can join us on Facebook, but pretty much Twitter is the main one we use for, uh, just passing on information that we like, things that we're looking at, potentially looking at anyway. And the bottom right-hand corner, you'll see us at YouTube. So subscribe to us at YouTube, and you'll see at that site there at Trade Setup, capital AU. And anytime we go live, you'll see a pop up. Anyone you can always join in if you like. All right, let's get into it. The US on Friday night. Well, it really wasn't a big night. I think our market was well contained. The SPY, you look at the SPY futures on the 30-minute chart, or even probably 30 minutes fine, I think. It was well contained between support and resistance. It was more of a range-bound session than anything else. And the same in the US. We had, I think, the Nasdaq was down when the Dow was up slightly, and the S&P was S&P 500 was up as well, only slightly. It was probably 0.3% either way. So really, it was more of a contained day. There's nothing big to tick it off either way. Um, I'll drop this down. Let me just get this chart up properly. Yeah. So not a big session today. We're up 12 at the moment. We're well contained at the moment. There's nothing too major again. We still got that daily move that we've got our eyes on. We've got a few. We've only got probably 4 stocks on the go at the moment, out of 10 that we normally have, or up to 10 anyway. We've got a few alerts that potentially looking to trigger. So I think we've got 3 buy entry setups that we're looking at the moment. So if they all get triggered, then we got 7 on the go. And even if this market's pretty stretched, still consider them good setups. And there's nothing. One's actually a Goldie too. So I mean, if the proverbial hits the fan, then that could actually still go okay. If gold spikes up, we've got to run on gold. So um, yeah, but even with this market, like I was saying, we were talking about the other day, it's quite stretched. You don't want to be left on the sidelines also, and just because the overall market's stretched, it doesn't mean there's things that are not going to run and not going to run hard. We've got BPTs kicking off into you'll look at that. We'll get onto that one now. Look at that. We've always looked between 170 and 80. I'm a bit concerned with. You can see that let's go to a bigger chart. But takes a look at that move up over the last, what is it, a weekly chart? It's 1, 2, 3, 4, 5, 6, 7 weeks. It's just blasted up. And there's a lot of talk. I know crude and is doing well. It's above $70 a barrel, but it's also, it's like a loaded trade, a full trade at the moment. The crude oil, the longer term crude oil trade, which means that a lot of people who want to jump in are pretty much loaded anyway. So there's a lot of potential fuel to cause a bit of a sell-off in crude. But look, we'll see. There's still, what is it, supply demands is sort of balancing out at the moment with, in the way of new production and some demand relatively. So that's creeping prices high. And then you've got Iran and the US sanctions on Iran could cause a drop off in global supply, and then a few other issues over there. So that's why crude's been continuing to edge high, which was BPT's kicking along nicely. Not going to complain. We're doing well on this one here. We've taken a partial. I think the partial was at 140, which makes that look pretty dumb in hindsight. But that's that's the way it goes. We bought it in here, took a partial up here just because of, again, that was that tentative market. You're looking at the market potentially rolling over. Might as well lock in some gains while they're there. You don't know if it's going to react lower from that. And it was getting extended at that stage. You can see it was drove up into 140, took a partial, and it hasn't looked back. So it's very strong. So it's whether or not, I mean, if we hadn't taken a partial yet, definitely would be taking a partial now, at around that 178 into that major resistance zone. But the way it is, there's no need to. We just would be happy just to continually tighten those stops, raise the stop on this, raise the stop, because it's well contained. You can see that that angle of that rally has been quite consistent. If we thicken that up a bit, see, it's quite level, so it's not getting out of hand. Every time you have it, then it goes sort of sideways. The MAs catch up and it goes off again, and then it sort of consolidates, only over a day or two, and then pops up again. G'day, Bobby. Um, So yeah, we'll just see if that can win. If it can blast through one, you probably find. Don't forget too, there might be a few. There's always going to be buy stops above there, and if they can trigger that off and it triggers it, a bit higher, so be it. And we'll just see how high it can get before we get stopped out. So essentially, that's the name of the game at the moment. It's just to see what happens, see how much we can drain out of this trade before potentially. I mean, it's going to have to correct sooner or later. Whether it just corrects sideways. I mean, if it has this kind of action, which we probably wouldn't stay in anyway. Just trying to think something a bit smaller. Say something like this. This is on the weekly anyway. Oh, look, you probably find we could get lucky and just hang in the trade while it consolidates sideways and then it goes off again. Okay, that's great, and we'll just see how far we can go. What are the others today? Whitehaven, we've got that kicked off in a nice way today. That's right up into that 5 zone. So my head's debating with me whether or not locking a partial, and it's not up that much, but whether we should be potentially locking in a partial up here or just to see how it's going. You can see the daily is getting to the overextended mark. The weekly is too. So, how much buying pressure could continue it on and up. But the weekly is the bigger one for me. I think it could actually push through there, being overextended or not. It is an indication of you've got to be on the, I guess your risk has got to be tight. Not tight, but you've really got to make sure that you know what you're looking to do, whether you want to take a partial, whatever it is, when the markets are getting a bit extended, because it's, the way you're looking at these is just how many buyers have really starting to pressure the market up. So for me, but that structure looks really nice. It could easily blast through there before, and it could just stay overbought. You can see how it did it back here, right back through, was it half of 2016 and kept grinding higher. So we'll see. And this is the structure. I really like that. You can see it's popped up, had a bit of a pullback there, took out the highs, and then pulled back, had a deeper correction, just took out that low, that higher low back at, what was that? That low's at 423. Then consolidated and started working its way back up again. So it spent quite a bit of time putting in that solid base. So that's on the daily. That's a good sign that this could just blast through that that high, 520. We'll just see. I mean, if it can pop through and then maybe run out of a bit of steam, then I'd want to take a partial a bit higher, say 510 or 20 or so, and just see if we can lock something in and just, again, let the rest run. Let it ride, you'd say. What was the other one? NST, Northern Star. That's the weeklies. The weeklies looking good. I like that. It's just been consistently grinding higher, so I'm expecting just to grind up through 7 and continue that run up. And you can see that that's quite what I like about this. And the reason why I got into this one is purely because you can see that's been well contained. It's controlled. It's not getting out of hand. So whenever a market starts to go vertical, you can see how this move here, it starts to curl up. That sort of price action is not sustainable. And it's very rare that the market can curl up, spike up, stay there, consolidate sideways on the highs. It's always going to be profit taking. I mean, we've all been through it. We've all traded. I guess most people here have traded for a while, back up and just stay there. They always have a bit of a pullback before they set themselves again, and then buyers are ready to step back in. And another thing, when they spike up, you're not going to get smart money is going to start diving in at the highs. That's for your retail punters, your people chasing the market, fear of missing out, all that sort of stuff. And that's not a big pool of traders really. With deep pockets anyway that are going to support higher prices. And that's why you're smart. Obviously, when you get spikes up like that, they're going to sit on the sidelines until it consolidates and start building a position when it has a decent pullback, which is what you're probably not. This didn't get out of hand, obviously, but it has had a decent correction. But this has been well controlled and I like that move there. It's been more sustainable to keep accelerating higher. Not it doesn't get out of hand on the upside. It pulls back, has your correction here, correction here. All these sort of high lows that have been building, pulling back to the MAs, reversion to the mean. So it's really nice. I like that one. We'll see if this one can continue. I'm expecting to get through that $7. Maybe not in the next couple of days, but just to keep continuing to grind higher, push up through there, spend a few days, be well controlled, and off she goes. G'day, Lauren. What was the other ones we got? Whitehaven. Did I go over that? Yeah, I did that one. Northern Star. There's one more. BOT. It's been like pulling teeth, this one. We're in at 14, I think. 14 and a half, I think it was. And pretty much got to 15 as we got in, and it's just stayed there. I mean, that price action still looks good. Don't get me wrong. You can see high, low here, high, low here. We've made taken out a key level at these highs at around, was it 14? Took out that with a little pop up, but then it's pulled back straight away. It's still in the midst of building a higher low, and you can see the stochastics are sort of oscillating between 30% to 70 or 80% when it pops up. But sooner or later, I'm expecting that to start curling up and getting ahead of itself. I want to see this type of price action really start to go on with itself. Yeah, look, there's a bit on the offer there. It's still a bit on the bid, so it might just be chopping around in here for a while before it gets ahead of itself. But I'm still expecting this to push up through 15 and a half and start to accelerate. That's what I want to see. If it doesn't quite accelerate, I might have to think twice about it. But either way, that price action, there's nothing wrong with this structure here, this price structure here. It's looking good. And that's about all we got, guys. I won't go over the ones we've got on the cards because that's that's paid content. You have to figure that out yourself. Yeah, so what I thought we'd just go over today, actually, we'll just check out what the markets are doing. I just want to see, I don't think there's been any major changes to the price action. See, that's the big S&P. That's actually not looking too bad. I think we were talking about it, that was Friday, that's Thursday. We might have been talking about Thursday prior to it breaking up through this high, prior to this candle. That's Thursday night after we had our last stream. Just wanted to see if it can break up through there, then that's looking a lot more positive. You got this little, pretty much a double bottom. We've got this major double bottom, which it's touched down here. I would call that a double bottom because of the rejection, this rejection candle. It's just flushed it out and then turned around and retraced. And now it's heading higher. So just from here, it's to see whether we can get up to that 28 or whether we fall short. We have to pull back, build some. It is getting a bit stretched up here. Whether we just touch through it a minor bit. Let's just take that out. Whether we just draw that, whether we just want to draw it. We've had that pull back there, popped up. We've had these two little moves down, and it's only really a washout. Whether we get higher than this, drive higher, and then have your little corrective action lower, and then really start to put in a bit more of a basing action before we head higher. Because that would, the more time it can spend doing that, the more likely I would see, especially if it falls short of that high at 28, the more likelihood I would see of that breaking up and through into new highs potentially. Because overall, this is all part of that building that base there. Or is this, this little pop up here going to be the same as what we saw before that just washed out the highs here and then we had a deep pullback? We're going to just wash out the highs here and have a deep pullback? Who's to know just yet? So that's why, it's always prudent to know exactly where your risk is on anything. Because if this starts to have a decent correction lower, then our market's going to feel it as well. It's just whether the stocks you have picked, you've jumped into, if that's the case, it does pull back. Especially us being well and truly overbought at the moment. If it does pull back, the stocks you picked, can they just consolidate and hold rather than capitulate? How strong is your setup? Or how strong is the price action on the chart? Or how strong is the trend? I guess you'd say. The Dow, bit the same. That's already broken. Whether it just goes sideways from here and you can consolidate or you can build a higher low or just consolidate sideways. You don't have to start trending. I could put in a nice little base here, consolidate for a while before it starts building. And the longer term, like I said, longer consolidation, the more likely this is going to start picking up again and start attacking those highs. FTSE Jesus Christ, look at that one. It's just kept going. That's really getting into those highs there. And so that was pretty much big flush out. This move down with all that drama with bonds in there, just a big flush out of these previous lows. And it pretty much this whole year, you can see this whole 2017, you can see the low of that, we pretty much took out within probably on that counter within 3 weeks. Yeah, I think we did. We flushed out pretty much the whole of 2017. Anyone that's been buying it in that grindy price action there, flushed them out, bang, pretty much turned on a dime, went straight back up again. So we'll see if they can find some sort of reaction up there, resistance up towards those previous highs, or whether it flushes out those highs, and then we start pulling back, and then resetting and just building this major higher low to continue high on the FTSE. DAX, not as bad, but it's still, that same sort of thing. This move down, grinding, washing out this previous higher low, and starting to trend higher. And we're onto our XJA, which is right up to that 6150 zone, which I think's proving a bit of resistance. Doesn't mean it can't just blast through there. It may get that initial, the longer time it spends not pulling back up here, the more likelihood it's actually going to blast, or at least going to put its head through that 6150. All right, so just keep an eye on that. You can see up here, it started approaching these highs, or not so much that. I'm just trying to think of one that's showing you. It's probably not a good one, but you can see this candle here accelerated a bit. This green candle accelerated. Then they started getting, you can see the selling coming in. It's opened up, pushed up, and then sold off into the close. It still managed to be a green day, and then this one accelerated down, finished on its lows, and then you got some selling from there. Whether this is what we're seeing just here, and this today, it might be a third rejection up towards that 6150, and then the next couple of days we get some selling, or whether it can just sort of chop, go sideways, and then if it spends a few days going sideways, good part of a week or so, not doing too much, then you might look at that 6150. We might spike through it before we have a good little correction. But again, we're not going to guess it. We just want to plan the different scenarios. So that's it. All right, now on to what I wanted to sort of a bit of a chat about today. I thought we'd talk about, and I find it interesting. We had someone brought it up in, I'm not sure if Bitwise on our Discord channel. I don't know if you're in listening. We were talking about buy right strategies or selling options, covered calls. That's what I'm looking for. Has anyone got any experience in covered calls? Does anyone get into them? Because there's a bit of an art form behind it. You can't just go and buy stock and start selling covered calls because randomly anyway. And I know from my past experience, I've traded a lot of options, not as much covered calls, more your index strategies with the FTSE, the DAX, SPY, sold calls, credit spreads, all that sort of stuff. I might be getting into too much detail with what we're talking about, but covered calls has been quite a popular topic with there's a lot of people out there selling systems, selling this, selling that. And to me, I've heard too much people say, oh, it's, you get your guaranteed income, blah, blah. Nothing's guaranteed. And I think people got to get their head away from that sort of thinking. Nothing's guaranteed in the market at all. There's always a hitch with everything. And I've seen some, not really sales, yeah, some sales pitch, but there's been some people that are selling strategies on cover calls, this, that, and the other. And I think they neglect some of the risks on them, where there can be a bit of risk on it, and you can get chewed up a bit, which is not what you want to do. I think what we're talking about, the main reason why Bitwise would do them is because he's got the stock. So if you've got a longer term portfolio of stock and you want to earn a bit of income when the market's going sideways, it's a great technique. If it's going up, when it's going up, it's a bit tougher. You probably have to pick the times you sell to. Right. So I'll go over them. I just want to pick. Well, let's look at the XJO as a bit of an example. If I was looking to do a covered call, so a covered call strategy, for anyone who doesn't know, is you buy the stock, the underlying stock, and you sell, I think, calls in Australia are 100 shares per call. So if you had 100 shares of, look at XJO, for instance, not that that's a share, but that's the index. I just want to use this as an example. If you had 100 shares of that, you might sell one call option. If you had 1,000, for example, whether it's BHP or whatever, or any of the banks or anything, you're doing them in groups of 100. Correct me if I'm wrong, but I'm pretty sure there are 100 shares It might be 1,000, but I'm pretty sure there are 100 shares per option. That's the equivalent. So you don't want to have 120 shares in something and sell 2 options, because you're gonna get screwed, and you're gonna end up a short position of 80 essentially. Your net position is gonna be short 80, and if the market keeps going up, you've got to do something about that. So you're just gonna be wary of what the underlying value or quantity of shares that if you get exercised. I might be speaking over a few people's heads, so just say something if you're not understanding it, and we'll try to explain a bit better. I think 1,000 for XJO, only 100. So it is 100 on the stocks. Perfect. All right, cool. So we'll stick into shares. I want to use this as a good example. All right. So when you're basically doing cover call strategies, if you've got a portfolio that you think, oh, I'm in this for the longer term, I've got some good solid blue chips in this, it is a very good way and a very handy way of earning a bit of income or getting a bit of premium. So you basically, what you're trying to do is sell some calls against your stocks. You might have, like I said, if this is BHP, for example, you might have 1,000 of these. You go, look, I could sell 10 options. You don't have to sell 10, you can sell 5, you can do whatever you want. Just to earn a bit of income while I think this is going to go sideways for a while. So for me, the techniques, I would still be looking at your technical analysis to try to pick the levels, because if this market turns into a massive bull market, it's not really the most convenient time or the best time to actually go in there and start selling calls. Although you can do it, I think it takes a little bit more finesse. And by finesse, if you've got a market that's trending, let's just get rid of that. I just want to draw up the best scenarios of where I would be looking to sell some options. So say the market's, you might find this is a big resistance zone, and the market could be trending in this zone when you think that the market's, your stochastics are getting extended to the downside. The market overall, your stock overall is trending higher. You're in a correction phase. It's correcting lower. It's been correcting, maybe about 30% of the move up, the previous move up, or you're around, 40% you've corrected that previous move up. The last thing you want to do when that stock is moving high, is trending high, is start to sell calls here, because there's a good chance that even by the time it gets potentially up to this high, your strike level to get any form of income is going to get you stopped out. And then if you are not looking to get out of your stock, then you might have to just think twice, take a bit of a hit on the option. Just depends when you sold it, how far out have you sold it, and what sort of income have you. You could sell it for $1. By the time it comes up to that strike level, it could still be $1, and you've taken pretty much no hit on it, or it could be $1.10, it could be whatever. So I think for me, the idea, because a lot of the factors in options is time. The idea is there's a time value. There's in your premium, some of that's made up of time, volatility, all that sort of stuff. So for me, I'm always trying to look to put time on my side. So if I'm looking to sell options on and using that type of call strategy, covered call, I'm looking for it to. I'm trying to look for a zone like that. If I think it's got extended, it's got a bit ahead of itself, and I might potentially just look to sell a call with a strike somewhere up here. So for example, you might have months. So that way, it's a good little strategy when the stock's looking to get a bit extended, and by your technical analysis, you think it's going to have a bit of a pullback. Then it may be a good time just to whack in some calls, sell some calls, and let time work for you. So the market does eventually roll over. It doesn't get anywhere near your call level, your option level, your expiry level, has a bit of a pullback. You're getting time under your side, and by the time it even gets back to where the price level of the stock of where you sold it, you might have got a month under your sleeve. You might just go, okay, I'm happy to just go buy that back, book the premium, or I might let it expire worthless. And that's the idea. That's the idea with anything when you're doing selling calls on shares. Anything, especially with sold calls, you either just want to let it expire worthless, and that's the aim. So by doing that, you're trying to get time on your side, or you just want enough time on your side to eat away at the premium, where you can book a little healthy gain. Does that make sense, guys? So if you've sold this for $1, you've sold it about that time, you might find by the time it gets to about here, your stock's roughly back at the same level as when you sold it, but it's taken a month to get there. Instead of being $1, that might only be 50 cents now. and you might look at it and go, look, I can book 50 cents, or I can take a punt that it could expire worthless. I'm never one for that on options, because don't forget, volatility increases. You can get time going in your favor, but volatility increasing the price of the option, and then it's sort of a two, it could work against you on that, and you'd end up neutral. But what I'll do is put it into the chat. Here it is. Here's a good book. I think. Oh, here's a good. Where was it? Where was it? Copy link. There we go. I've chucked it in there. So this is an ASX link just about explaining about options and different bits and pieces. So just have a bit of a look at that. All right. And the other way with the options, if I'm looking to sell, I would ideally be looking up into a key resistance. And that's why I like, if you're coming up into a key, you pushed up into resistance, you might have backed off, you might be pushing back up to retest it, or you're building a lower high. I'd be more than happy just to sell some options above there, because again, I know that for the market to, even if I'm wrong and it does break it, I could easily get a good amount of time up my sleeve, which is going to eat away at your premium, your sold premium, and then you don't have to let it. The last thing you really want to do, if you've got stocked on your books, on your portfolio, that you want to hold, you don't want to close out, is to get that the price level to approach your, to actually push up into your zone, and it basically hits your, what do you call it, your strike price. If it trades your strike price, then you've got an issue. Then they match off together. All of a sudden, you've got a short position on the options of 1,000. It closes off with your 1,000 long positions on your stock. Okay, you make a profit. That's all good, but it's not what you want to do. It wasn't the aim of it. I mean, if you've got enough money, you can always go do your cover call. You can go buy your stock at the same time you sell your calls. What people forget, you've always got that risk of the stock going down in that case. So that's why it's a really good method of earning income on stocks that you're happy to hold, whether it's a dividend play you've got the stock for longer term, you like your dividends, you've got it, you're not anticipating on selling it on the next month or two. So I think a lot of the people out there selling these sorts of systems are saying, okay, we can get the stock, we can buy the stock, you sell the call, even if they expire worthless, so you can redo it. So if they do match off, if the market does rally and it hits your strike price, okay, they match off, there's no risk there. But what they forget to say, there is risk to the downside. There's risk of buying that stock just randomly at a random price just because you want to sell options against it, and they roll over, and then you're going to lose. So it becomes pointless selling the options. All you're trying to do is make a bit of money back to cover some of the, a part of the losses if the stock starts to drop out of the sky. So it's always important, if you're doing it that way, you've got to start looking at your charts. Say we're looking at the ASX, for instance, we might have been looking at buying some stock in here. If this is a stock chart, say this is a CBA, it could be any sort of, let's actually look at CBA. No, I don't even like, even down here, for instance, if you've got, I wouldn't buy stock just here because this could easily push through. But if it starts to lift off this support, we're in a handy support zone at $70. If you're going, okay, I want to buy some stock at this, I don't know what they're going to do from here, but I'm expecting that to come off that support. I want that support to hold up. If you're just looking at as a pure, like you're looking at, firstly, you're looking at, I like CBA, I think it's a good zone to buy. Okay, that's just one separate trade. That's just a particular trade you're looking at to buy CBA off this zone here. Going to hold it longer term, whatever. I might hold it for the next couple of years. I don't care. I think it's a good stock. Eventually, it's going to be high. It's going to be trading up towards 90 sooner or later because it's a bank. So that's your overall theory. It's a good price to buy it here. Now, if we start, there's going to be all these on the way up. There's going to be all these little resistance zones where you can start to, okay, you get up into a resistance. I want to start doing hold that because I know my longer term objective for CBA is to hold it. All right. So if you want to hold it, it could be every time it gets up into a resistance zone, start looking to sell some calls, earn that extra premium on it. You might find that there's some little ones, if you buy it off here and you're right, and it goes up to 74. All right, we might find at 74, we start getting a bit of reaction off there. Might sell some calls up towards 78. They might have a month to expire. I know somewhere within there, it's a long way away. I'm going to get a chance to book some premium to buy them back, and then I'd go and repeat the process the next time it starts to push up towards resistance. The last thing you want to do is to start buying it here. And like I know some people would spruik, say, let's buy it. We're at the support zone on CBA. Let's buy the stock and sell some. At the same time we buy, we go and sell some options because the options might be up towards 74, and all of a sudden they've gone up. They close you out. Okay, you make a profit. But what if your whole idea was just to buy that and just to earn the income? What they would say is low risk, and the market heads south from there. To me, that I just find that pointless. So I would always be looking at, if I'm looking for that type of strategy, a buy ride, a covered call strategy, I'm always willing to look to buy that stock at a time when I think it's going to start heading higher, or I think there's longer term, it's starting to trend higher, it's coming off a good base, because there's always that downside risk on the stock. If you're not worried about that, if you're just purely looking at doing some covered calls, does that make sense, guys? Am I getting too sidetracked? But definitely for me, if a stock's heading lower, I wouldn't really be looking at it. I want to be looking at stocks that are heading higher if I'm looking to start that sort of covered call strategy, or if I haven't got the stocks in play, or if I don't have them, I'm purely looking at stocks that are going to trend higher. I think there's a good chance that they're going to trend higher. They've had this they've moved up, they've pulled back. I'm looking to buy somewhere in here because I think this stock's just going to continue its way higher, and then I'll be looking for opportunities after that when you come into resistance or something where I've got the opportunity to sell some calls against it and start implementing that cover call. The last thing I want to do is buy on a pullback, uh, you know, when it's up in a resistance zone and then it starts making that lower high. I've bought it to start this cover call strategy, and then I'm behind the eight ball on the stocks. If your idea actually is to hold it longer term, okay, then that premium is going to help offset the losses. But I don't think that's the best way to start it anyway. Uh, no, you you can buy back the stock, Paul. If Are you saying that if you've bought some stock, if you're just like I said, if you just bought the stock for purely the basis of a cover call strategy and it backs off from there, like I said, I reckon that's just the wrong thing to do potentially. I think it's a very good strategy if you've got stocks on there and you want to start doing some cover calls because you're going to hold them longer term. You might take a bit of heat, that's okay, or you may have already taken heat. You might have bought it a long time ago and you've just had them for a while, but you're not anticipating you're going to close out the cover call strategy. I don't think that's the best way, and it could easily drop. Now, you don't necessarily have to. You could close out the stock and have just a sold call, because don't forget, it just means you're going to have a margin issue. Because basically, if you've got stock in play, you're not really worried about the margin because the margin's offset by the long stock on there. Yeah, that's true. Um, yeah, no, that's true. So you could I'm just trying to think of a way to explain it. When you've got, if you can just go and have if you've got 100 grand account, you've got no positions, or you can go sell the calls, no worries. But you could sell naked calls in there, but you've got to have that margin issue. And if the market starts going against you, and you've got sold calls, the market starts going up, that margin's going to increase. But as long as you can cover that margin, that's okay. All right. But if you've bought and you're doing a covered call strategy and the market drops off, that's fine. I mean, especially if you're looking to hold that stock, that's fine. Then you just look for a chance. If it drops off quite sharp, then all of a sudden that price of the option is going to be worth closer to zero than if you sold it for a buck or whatever, or it probably wouldn't be a buck, 40 cents, for example. And then the market, you happen to get it at the right time, it's peaked, and then it drops off quite suddenly. There's a drop in the US. All of a sudden your options go closer to 10 cents than anything else, because there's always going to be that time. If you've got a month to go, they won't go to zero, but they'll go fairly close. And you might just look at it, look, I'm just going to take the chance that I'm going to buy back my options. I'll just buy back my options and close them out, book the profit, and then just wait. Does that make sense there? Is that what you mean, Paul? Does it mean if you cash and just, yeah. I mean, if you bought back your stock, or you sell back your stock, then you've got the cash in the bank and you've got the cash to cover the margin. That's not a problem. So you don't have to technically lodge it. You don't have to have stock in your account to be able to sell calls. You can sell them. If you buy back the option, or are you saying buy back the stock? Oh, sorry, it's selling out of the stock. If you've sold calls, you always want the market to drop to make money. You're not buying calls, don't forget. Yeah, okay. So if the market, if you sold a call up here, yeah. So I think we're getting along the right track. I just want to get rid of that. I'll open it up so it's nice and clean. So basically, I think what you're saying, Paul, if I tend to forget how complicated options can be. If the market's heading up and you've got to that point here, you just started to, you think, okay, we're in a good pullback. What we've done is we're selling a call with a strike price up here for say $1. All right. I just want to, how do I do that? $1. Just a nice round number. So we sold it there, it's $1. Now, if the market does do what you said, it sort of chops around here for a while, and then whatever happens and the market starts pulling back, what at this stage, so you sold it at this stage for $1. At this stage here, it won't be worth $1 anymore because you've got sold calls. So the sold calls, and you've got two things working in your favor. Even if the market goes sideways, the price on the option is going to drop. If the market actually drops, you got your price of your stock has dropped. That option is going to drop even further. So it might go from $1 down to, just say, for example, 50 cents. All right. So at that respect, then you've got to sit there and go, well, at that respect, I think maybe here we're starting to base out and we're going to start to lift again because this overall trend is up. We're coming off support. And then I just go, look, I'm just happy to buy that back. Buy it back at 50 cents. I've made 50 cents profit. I don't have to worry about my stock at all. All I'm doing is looking for the chance to, okay, it's starting to go up again. And I'm looking for the next time I can sell it when it gets up to here. And up here might just go on, I wouldn't sell the same option with a different strike price somewhere up here. Might go and sell for another one for $1 and do this and just repeat that process. Does that make sense? Um, yeah, you do. That's the whole point. But if you, Paul, you need to hold the stock if you're exercised, but you're only going to exercise if your strike price is hit. So I sold at $1. The price of the stock might be $4.50. It might be a strike price of $4.50. Just say, let me get that up there. Just say, but at this stage, it might be trading at $3.50. The stock might only be trading at $3.50. By the time it gets to $4.50, I've already locked in my profit. I don't have to worry about the strikes. Uh, see if your stock is stuck in collateral. Yep. If you sell, sorry, Paul, if you sell CBA call for $1 and then the stock drops $3, then what do you do? If you sell a call, we're talking about the premium, so that there's two different factors. You've got a $4.50 strike, for instance, that we sold for $1. And if it drops, that's great. If the stock drops $3, it's CBA, it might go from, what is it now, around $70, might go to 66, we don't care. And we sold something for $1. The strike price hasn't changed. It doesn't matter. The strike's at might be at $74, for instance, on CBA. Is that making sense there, Paul? And then we just watch the premium drop because we want the market to go down just to buy back our calls. No, you can always buy it back. If the price, it's not. Oh yeah, you are. That's. I think I know what you're talking about here, Paul. If you've got the stock has gone down, the stock's gone against you, but the whole point of having the stock is because you're going to hold it longer term. So you're going to get these swings and roundabouts. You don't really care about the price of it. If you do, then you probably wouldn't be trading. You wouldn't be doing the cover call strategy, because if you're looking at the short-term loss and you don't get exercised. You never get exercised if it hasn't hit your strike price. So you still got your stock. If this if you've got CBA, for example, let's just go down and we'll show you. If you've got CBA here, I'll draw it up. So if we've sold some calls at 75 bucks, all right, that's your strike price is $75, and we sold them for $1. Yeah. No, exactly. That's the whole point. If we're doing a cover call strategy, if I'm going to do it, I'm going to use the stock that's in my portfolio, because I want to hold the stock longer term. I'm not worried if it goes up and down like a yo-yo, because I think over the next few years it's going to be higher than where I bought it. That's all I care about. It's just going to take time to get there. So if you're going to hold it, why not earn some premium off it? So yeah, this is my, you probably nailed that, Paul. There's a lot of people out there talking about covered calls and all that sort of thing, but they forget that you can always lose on the stock price. So if you're not looking at where you're buying and what price the actual stock is, and if it's not on the rise, if it's coming down here, you can sell calls. Okay, it's great, you're making premium. They talk about it, say, look how much premium you made, but you've lost that whole much on the stock. And so what if the stock goes sideways for the next 10 years and you don't want to hold the stock? You don't look at it longer term. Um, yeah, then you're getting smashed on the stock. You might have made your premium, but it's a kind of a pointless exercise. So you're really looking at two market scenarios. You're either looking at the market going sideways or going up. If you're going to start a covered call strategy, you have to go and buy the stock just so you can start writing calls against it or start selling options against them. And then there's no way you'd be picking a market that's going down. You want to be picking a market that's rallying. It's trending higher. So longer term, every time it peaks up, you sell a call, it pulls back, you buy it back. It peaks up, sell a call, pulls back, you buy it back. So that premium, you're making the premium safely without taking a hit on your stock. And if you can do that for a year, you might have started doing this. Say the market perks up off here and we get CBA start pushing up off support. We've taken out this little lower high, it starts picking up and it starts trending higher. And we bought it. We bought the stock because we think it's going to hold up off support. And then when it starts picking up, we've got confirmation it's trending higher. We might start selling some calls against it, because our aim is to hold that stock longer term and see if the stock can rally up to 82, 83 bucks. And we can potentially make some premium off the back of it as well. Does that make sense to everyone? So there is, I think, just with that little discussion there, we pretty much nailed what the problems are with cover calls, and it's not as simple. It's not as simple as what people think. There's a time and a place to do cover calls. There's time for selling, and it's definitely not when the market's dropping. I mean, if you drop $3 and you made a little bit, you made 50 cents on your option, and then you go and close out your stock. That's kind of a dumb thing to do. Because you're obviously going to lose it, and then you don't go and, okay, now I'll just go buy the. And I know I've heard people say this in the past when I was broking as well. I've heard people say, yeah, but you go buy back the stock cheaper. It just becomes a pointless exercise, and it's not worthwhile. If the market's trending between support and resistance, the stock itself, and then every time it pops up to resistance, you can sell some calls. It comes back down, you buy them back, and you can just rinse and repeat that way. But you've always got to be careful on the technical side. If you're coming up to resistance, are we going to react off there? And if not, if it just keeps going through, then forget about it. Well, yeah, if it's not just in the range, but it can trend high as well. I think we've looked at an example. If it's trending high, every time it perks up, it picks up, you get a new higher high, then you can potentially sell some stock. Because it's always, don't forget, if it's going to make new highs, it's always going to take some time. And the time is the thing that's the key, I think, with selling options. Let's look at Westphal. Look, that there, for me, if you were doing a cover call strategy on that since 2015, and you could say it perked up here and started backing off. If I sold some calls here when I thought this market was going to roll over, I'll just go and nut out. Where am I? Of a good little time, I would see as a good chance to potentially sell some calls. So we can all see that it's pretty much here. There's a massive resistance zone through here, and there's probably There's a few different support zones through here. If I started seeing it when it pushed up here, you've got to this level, we traded off here, we're starting to head down, I could sell some calls here. All right, so I might sell some calls up here, and it's turned out all right. I wouldn't sell some if it picked up here. I wouldn't sell some just because it's really hard to know. I wouldn't sell some here because it could always turn around and bang straight up to resistance. It's going to clean me up. I would always be looking at that major resistance zone. If it pushed up here and it started coming back into the zone, you could have sold some up above that level, above that level, above that level. Every time it sort of approaches there and starts backing off from a resistance zone, and you can see here it was a bit tougher. You pretty much got it pushed up through that level, and then the next it was a couple of red candles to push it all the way down. Here you had a great little you can see that lower high. You can see it just there. That lower high is a great example. Then you've got the market start to roll over. You could have sold some calls up here. The same here. You got this lower high coming to play. You could have sold some calls above there and been fairly safe doing it because you know that this has been range trading. So it could be, but you're never selling it when it gets down to support down here. I would never go to sell calls because your strike is going to be somewhere in the middle of the zone, which means you're leaving yourself to get, exercised on your stock. Exercised on your options, and then you have to take a hit on your stock, especially if you bought the stock at say $44 and all of a sudden you're getting exercised at $42.50 and you've made 20 cents premium. Your net result, you're down. So if you bought the stock somewhere around $44 and every time it pops up you're in profit on your stock and you're looking it's up at resistance, looking for an opportunity to sell some calls with your anticipation that this market's going to start pulling back and it's going to continue range trading. So that's just one way to trade cover calls. So we've probably gone into depth quite a bit on this. Probably shouldn't have picked this picked this topic. Does that make sense? So for something you can see it's quite a clear range trading scenario on the stock, then yeah, every time it pops up, I would be selling calls. And looking if they haven't closed out, they haven't expired worthless by the time it gets back down to support, then I probably want to close them out. I mean, you can always wait for it to come back up because don't forget your strike price is way up here. By the time you get back up here again, I could just roll them over. They may have expired. If they're not, they're going to be next to worthless anyway. And then I might just go and sell some more calls at a higher price. So that's one, when the market's trading like that, if it's starting to trend higher, I wouldn't when it's trending lower. I would never want to start selling calls when it's trending lower, purely because you don't know if it's going to start finding support. And especially if it's dropped off quite hard, it could just turn around and rally really hard. All of a sudden you're going to get caught out. And it always, in that scenario, it always going to depend where you bought your stock. So if a market, just trying to think of something. If, for example, the market started heading south, you got lower highs, I wouldn't start selling a call up here, buying the stock, especially if you're new. If it's a new trade, I wouldn't buy the stock and then start selling calls against it, because if this is your initial entry price in your stock and it goes down and you've got these few options to actually sell the calls, and then your last trade you've done is selling some calls here, bang, you get stopped out. You've actually got to make sure that, there's your premium you've earned on the way down may not be covering when they get exercised, your stock exercised and your options exercised, and they match off. You might take a big hit on your stock because you bought the stock way up here and then you got exercised when it was way down here. Okay, you've earned a bit of premium, but you might have lost $3 on your stock and made $1.50 premium. Now that's not a worth. It's too risky to do a cover call when the market's heading down. When it's heading up, it's great. I think it's a good little strategy. Anyway, we'll probably knock that on the head for today. Has anyone any questions on just what we're talking about there? Otherwise, just chuck in some stocks, guys, if you want to have a look at something before we get finish up. All right, what else have we got? Up 16. All right, we're ticking along all right. BBT, should we tighten the stop? Yeah, Lauren, to be honest. Yeah, look, I probably would, mate. With BBT, PMV, we'll have a look at that. Let me just go over here. BBT. Yeah. All right, what I'll be looking for on this one. My main thing about tightening the stops up is that you're not just tightening. If you tighten it here, for example, and look, it's probably about okay for me. I'd probably be happy with tightening to 165. You can see what I'm trying to do. If you've got support zone there, the rising support, and you tighten it, and it could get tagged before it even gets down to support, it's not worth it because then it can turn around and resume the trend up. You might get caught when the market's popped up. It's these two sort of legs down, stopped you out. It's resumed the trend and then started to head higher again, and then you get stopped out. It adds on another $2 or whatever. You want to be careful just where you place it. It's not my usual way of raising stops, but I think because we've taken a partial and we want to tighten up on the second half, the last thing I want to see is it pull back all the way back to 130. I could have taken essentially 50 cents profit on that, but instead I've tried to, because off this daily chart for me, well, you could just about keep it right down here. You've taken a partial at 140, but I don't want to see all this turn around and retrace because it's such a resistance zone, such a strong resistance zone. I'd rather lock it in up here because I feel once we do pull back from here, if I get stopped out, and especially if we break um, through the support zone, especially if we break through that support, I think we're going to have a deeper correction. And where we go to, I don't know, but I'd rather be out watching it resetting itself and letting it pull back. It might do it at $4.50, well, $1.40, $1.50, $1.55, I don't know. But I'd rather let it pull back. I'm out, reset itself longer term. Might take a few weeks to do it, a month, a couple of months to reset. Look at this from here to basically here before it started trending high again. We've got a good little confirmation, high low here. What was that? 2.5 months. So I'd rather be out, let it do its thing, base again, rebuild, and then look to see buyers start to come in, get the higher lows working, and then jump back into it. If I happen to jump back in at the same price, doesn't matter, doesn't bother me at all, because all it's all about is risk. All right, we're just trying to analyze the risk on it, and tighten it up because we know that 170, 180 zone is it's going to take a bit of effort to get through, and I think a lot of juice in the trade, a lot of buys being used up just getting it up to 170, 180. That's why I don't know how many people are left on the sidelines to buy it and push it up through 180 without having a decent correction. Does that make sense? Yeah, I'd probably be happy to tighten it up. Maybe not to exact one, maybe 165. I'll see. What's our stop on that anyway? OT 160. So that's a 5 cent rise. All right. What was the other? Thanks, Paul. See you, mate. What was the other one you said? PM, MV. Yeah, let's look at the weekly. See this weekly? This is probably a good little example. I'll draw that up. It's a good example of consolidating around the highs. I'm just looking at this purely. The one thing I don't like is the fact that it's getting an overextended mark up here. It's a bit overstretched at the moment, just around that $16 range. But when you see this type of price action, we've had this lift here, had a good pullback. We've had another lift. And the way it's consolidating around here, instead of you can see the last time it had a bit of a lift, next couple of candles were down. It didn't muck around. It didn't go sideways. It just up, turn around. Next week it started heading down again, got all the way back down again. Instead, we've had a bit of a lift, hit 116, and we're going sideways, essentially sideways, stuck in more of a range between some support and resistance. That's not a bad sign. So if we drop that down to the daily, because we could easily just lift from here, we could easily I'd rather see it pull back. I'd rather see a higher low from here. Each to their own, but what I would like to see, that's sort of our range at the moment. We're sort of capped up at that level. I'm seeing a minor support level up there. I wouldn't buy it within this zone at all because it can keep, there's nothing to me saying that could go up or down. The only thing is the MAs are starting to rise again. They're starting to lift. So ideally, I'd like to see it's just coming off. This is that move up. I'd like to see it's just getting up to that resistance, bit of a pullback, maybe a little high low, and then go. Then I'll be happy to buy it. I know exactly what my risk is. I've got the high low sort of in the middle of that, the meat of that range. And then you anticipate it's going to break out. And if it doesn't, it stalls, fails, whatever, and you're up slightly, I'd be inclined just to nab that and knock it on the head and close it down. But yeah, otherwise you're just going to buy it on a break through these highs. What's that? Buy it on a break through highs 16.15. Say 16.17, you've got your stop below around 15.50, just below the bottom of the range, and see if it can just lift from there. And then you've got your next, 17 is probably a potential first target, then up towards 18. So this could easily rally. I mean, this weekly looks really good to me. All right, you've had this sort of push up. We've had this pullback. It's washed out a lot of traders, a good part of actually all year before it started. It spent pretty much 2017 basing, coming down. It found that low at $12, and it built a high low later on in the year, and it started rallying into the end of the year. Then we had a little sell-off, and we popped back up again. So that structure is actually quite nice. So buying it, like I was just saying, off that daily, a break through the highs of that little range, 16.17, I think I said, with a stop at 15.50, actually makes sense looking at this weekly chart, because it's actually holding around that level. So it actually looks quite strong to me off the weekly charts. It's just that daily looks a tad messier, but off the weekly, it actually looks pretty good. It's just, I'd rather see this roll over. I'd rather see it hold this level when the stochastics are coming down. It just means there's a bit of selling pressure in there. They're trying to push it down, but the buyers are hitting it, equally roughly, and they're getting the stochastics actually dropping off. All right. What have we got? PNV, CCA. Brent, you into CCA? Yeah, I like CCA. If anyone doesn't know, I'm guessing you all know by now. The weekly, look, there's massive rejection up there on the weekly. It's had a big sell-off down towards that 70 zone. It started lifting off 70. What I'm looking for on this, the overall structure, it's a slow-moving boat, and it's getting these little blast ups and blast offs to new highs. And everyone know, I guess if you don't know, you've probably heard me talk about it before. The story behind CCA is obviously with Ivy Coin. It's now called Ivy. The token, which has got some really fundamentally has a really good story behind it. And if they can do what they say they can do, I think that's going to really take off that token, Ivy Coin. If that's the case, these guys hold a bucket load of them, and they're going to be very profitable. So their underlying, profitability is going to be great. It's going to be a cracker, and that's why you can see it's been pushing up on the story, on the back of the story. Now nothing's happening. That's probably why you got this. Everyone bought up CCA on the back of that. Took a bit of time. Selling started coming to CCA. Pushed it back down. But overall, it's actually holding a higher low, and it's very mildly on the weekly charts anyway. So it can get choppy. You can look at this, that sort of support line through there. It's just come back down to support, lifted. It could easily come back down to support. So it's going to give you a bit of heat if you bought it up, which I did, around the dollar mark. So I've accrued some position up here. Average is, I think for me, is around $1, just below, might be 99 cents. So I'm quite prepared to take some heat on that. It doesn't really bother me too much. So I think sooner or later this is going to start getting ahead of itself. Now, what I'd love to see from the daily is this. See how it's edging lower, but it's not with too much conviction. Like it's not rolling off the cliff like it did here. It's grinding lower and then started rolling over, and you get these bigger expansion days lower. I think it's going to hold this trend up, and if we start getting some buyers popping back to $1, chopping between 95 and $1, I think it's going to start to lift again, attack through, $1.10, and maybe attack up towards those highs, $1.35. Now, if that coincides with a bit of news on Ivy, great. Especially if you do have some news coming up on Ivy, I think that's going to take off. Are you a holder of this, Brent? Just let us know. We'll get on to CGC. Look, that looks good. Costa Group. Why do I know Costa Group? I don't know if we held this before or not. I mean, that weekly looks like it's done this little cup and handle type of pattern. It's had a little expansion up, had a pullback to clean out a few of these late buys. It's holding. We've held this inside, if you know what I'm talking about, you've been following me for a while, we're holding an inside high low here. So this little gap up, push up to highs, it pulled back, it retested the sort of, the gap, I guess, open level, all those lows through, what was that, 670, popped up. If this was weak, you would have expected to close the gap right back to around that 620 mark. Instead, it didn't. It held this high low. Buyers stepped in above 7 and it started lifting in again. So I'm expecting this to start attacking through 760, 780 and into new highs. It looks kind of good. It's a bit extended up here. You can see it's been grinding up into overbought territory, but that price action looks really nice. Coming up into a bit of resistance up towards that high, 768. What did it touch on there? 763. So it fell short of 5 cents or so. Doesn't mean it can't just keep grinding higher, especially after this higher low. That's strength in buying in there. So it looks actually good. Ivy to the moon. I got a feeling you're on, Brent, are you on Telegram much? I reckon I've seen your name on Telegram a few times. If not, we'll see. All right, what else we got? Ivy to the moon, agree with you. AEB. Look, AEB, again, it's this, I don't know if we've talked about this before. It's that little spike high. Obviously, it's sort of news release has kicked the tire. I thought it was, mate. We've got this good little news release that's kicked it high to new highs, but the way it's just sold straight back down again to where it pretty much started, around that 2 to 3 cent zone. Don't like that so much. Okay, you expect if that's good news longer term and it's supportive of the stock, it shouldn't have pulled back that much. All right, so now it's actually starting to base off again and it's holding higher lows and it's looking okay. But for me, this one's going to be triggered. A rally in this is going to be more triggered by news than anything else. I don't see, I mean, because the weekly's not looking that flash. The weekly's looking a bit the opposite. It's had a big sell-off. It's grinding lower. Tried to go up, grinding lower again. It tried, all this really spike did was just take out these highs or really retest those highs, and it's straight back down there again. So for me, but forget about the news. If I'm waiting for news to come out, and if it does come out, it means I've got an inside source somewhere if I'm going to buy it on the back of news. But purely off a technical basis, I wouldn't be buying that on the weekly at all. And I need to show it. It needs to show me some more strength. By strength, I would want to see this. It has to hold up here, and we really don't. It's just been growing. That big sell off here, lower high, press down. I mean, the steepness of that sell off is not so bad, and it's getting a bit choppy in here. It started to lift, minor higher low in here. Started to lift a bit more, but it's not lifting that much. I'd rather see it less. Sort of grinds higher. It could just grind higher and then roll over again. But we'll see. I'll just have to wait and see how it goes. But yeah, it's not set up for me at the moment. The only thing working in its favour, it's down quite low. I still don't think that's the best reason to buy it. I want to be a buyer when it's starting to lift. What was the other one? Tox. Yeah, what do they do? They've obviously had a bit of they're suspended, are they? What news have they ever takeover bid, have they? Quotation. So it looks like a takeover bid or something, I'm guessing. Agya? Quotation. Close of today, Friday the 11th of May. All right, can't trade those anyway, so. Takeover by Cleanway. All right. This is sort of a bit late. I wouldn't touch that, to be honest. I mean, even if it was trading, I probably wouldn't touch it. The fact that it's gone up here, takeover, obviously they've said the price is somewhere around probably 350 a share, and it's just hovering below that 350. I wouldn't want to buy it. I mean, for me, the upside is about 4 or 5 cents at the moment. The downside could be quite significant. There's a bit of profit taking in that. So yeah, I'd be stepping aside on that one. Anything else? Oh, that's pretty much it. Just under one. Yeah, no, good work, Laurent. I just saw what you're talking about. All right, guys, probably have to call it a day there. Sorry, I got sort of stuck on the buy ride. I think it was a good thing to talk about in hindsight, but maybe it was a bit more complicated. But I think it's just something I saw and I know in the past there's been quite a few people that get a bit confused on it or get not confused as such, but get sold by a few of these. I wouldn't call them sharks. I mean, it could be a good little strategy. And I've seen guys that I've worked with or I knew through the company I worked with or worked for. That was a big thing for them. But then when the market turns out, they got crucified. Um, and if you're just sort of sitting there going, oh, we'll just keep rolling, keep selling stocks, I mean, sooner or later it could catch you off guard. I'd hate to see people get sold to on the basis they can just keep making income and look how much I can make. That's great. And then all of a sudden get cleaned up. I'd hate, you've got to know the ins and outs of everything. There's no free lunch, I guess, in any trading. There's nothing, nothing. I mean, if there was, you'd have funds making more than 6%, 6% a year. That's before cost after time. I think they'd be making a bit better than that. So if it's easy, if you know trading's easy and you can make money easy, it's risk free. Uh, yeah, everyone would be doing it, and it actually neutralizes that anyway. So, all right, we'll probably call it a day there, guys. Thanks for joining me. We'll be back in on Thursday. I hope you all have a good day. And yeah, I just saw your comment there, Helen. To give you, I mean, I was selling options on crude a long time ago. I don't know if we were telling, I was just doing them naked calls. And my pure strategy behind that was selling them when the markets had a big spike because it's what I've always talked about with trading. You know, when the market's gone up quite hard, it's the way I view it is it's probability. You know, to keep going higher, it's a lower probability that it's going to keep going higher. But it's the higher you go, the probability of a retracement starts to increase. Does that make sense? It's like an elastic band. Every time the market rallies, it's like stretching out an elastic band. It can only go so far before it breaks and rolls over. All right. And when I was doing crude options, when it went from basically $60 to $140, I was just selling naked calls. But the whole basis was we had an account, say you had a 50 grand account. The maximum I would use for margin was 50%, up to 50%. So however many options we could sell was based around the size of the account. Um, and then I would never sell them on a pullback. Never. Always be looking to buy on a pullback. It's you know it's buy the dips, sell the rallies type of thing on the options, and that kept me going quite well. So when the market rolled over, I did get caught. I got caught on. I don't remember. I think I got caught selling some puts. I tried to do it. The market rolled over, got smashed on some puts. Tried it one more with a covered put, got a little bit less smashed, and then gave up after that. And then waited. I just basically sat around and waiting for the market to bounce back up again. And it did bounce back up. We started selling some calls again. And then eventually that trade, it was a good couple of years, but that trade disappeared. There was high volatility, means really good premium prices. So it was worthwhile. It was worth the risk. I was selling them miles away from the market. So for me, it was a low risk strategy, even though people say selling calls is a high risk. It can be if I'm selling it in a very low environment. Say if I went and sold some crude calls now to get any half decent premium, I've got to come really close. What if the volatility explodes on crude? Bang, I'm going to get smashed. And I did get smashed at the start when I started doing it and changed my strategy, and it worked really nicely. But yeah, you got to know your options if you're going to trade them. You got to know what the ins and outs are. What makes up an option. The only thing I really worry about is volatility and time. And those two sort of things that make up the premium. Yeah, you got time decay. Time decay is your friend when you're selling, but you've got to make sure you sell at the right time. And again, it just comes down to it's like any other trade, your timing. Yeah. So yeah, look, I reckon options are great, and I wouldn't mind getting back into them. But I just think it just comes down to the premium. You get low volatility, you're risking a volatility explosion on anything, and you get caught. Bang. Yeah, no, you're right there, Helen. All right, we'll call it a day there, guys. Got out of hand. We'll speak to you again soon on Thursday. Have a great few days. We'll speak to you then. Cheers, guys. Bye.